We are living in a moment that historians may one day remember as one of the greatest financial bubbles ever created. And here is what makes it different from every bubble that came before it. This one is going to be funded by you, whether you choose to participate or not. In the coming weeks, your retirement account and your 401k are going to be purchasing shares in some of the largest IPOs in human history, not because you asked for them, not because a financial advisor recommended them, but because the rules of the financial system were quietly rewritten to make sure that your money flows there automatically. This is not speculation. Larry Fink, the chairman of BlackRock, the largest asset management company in the world, said it plainly. Retirement funds and pension funds will be used to build out artificial intelligence infrastructure. His exact message was that the capital is going to come from the private sector, from savings accounts, from pension accounts, from insurance companies, across the board. So, let me walk you through exactly how this works. There is a concept in finance called an IPO, or initial public offering. That is the moment when a private company opens itself up to public investors and lists its shares on a stock exchange. One of the companies preparing to do this right now is SpaceX. Its expected valuation at listing is $1.75 trillion. To understand what that number means, consider this. On day one, SpaceX would be worth more than every American defense contractor combined. It would be the largest IPO in human history, surpassing Saudi Aramco, which has held that record since 2019. The critical difference is that Saudi Aramco was the most profitable company on the planet when it listed. SpaceX lost $5 billion last year. Now here is where it gets important. The financial rules designed to protect ordinary investors from buying into overpriced companies at the wrong time were changed right before these listings were announced. On May 1st, NASDAQ introduced what it called the fast entry rule. This change did three things. First, it cut the waiting period for a company to be added to a major index from as long as a year down to just 15 trading days. Second, it eliminated the float requirement. A float is the percentage of a company's shares that are available to the public. Under the old rules, a company needed at least 10% of its shares publicly available to qualify for index inclusion. SpaceX plans to list with a float of around 4 to 5%. Under the old rules, that would have been an automatic disqualification. Third, and this is the part most people have not noticed, the new rule artificially inflates how a low-float company is weighted inside the index. A 4% float gets treated as if it were 12%. A 5% float is treated as 15%. That is a multiplier of 3 times, and it means that index funds are now legally required to purchase more stock than the actual available supply would normally justify. The NASDAQ did not write these rules for SpaceX alone. They wrote them for a class of companies. SpaceX is simply the first in line. Behind it comes OpenAI and Anthropic, both planning their own public listings. 3 companies, a combined paper valuation of roughly $4 trillion, all going public within months of each other. And NASDAQ is not acting alone. The FTSE Russell Index is allowing inclusion after just 5 trading days. The S&P 500 is making similar adjustments. Every major index provider is updating its rules at the same time, just weeks before the largest cluster of IPOs in modern history. You could argue the rules simply needed modernizing. Maybe. But the timing makes that argument difficult to accept. So, why are these companies rushing to go public right now? Why not wait? To understand that, you need to understand the accounting architecture that has been holding up the artificial intelligence boom. The trillions of dollars in valuations, the record earnings reports, the headlines about technology companies generating historic profits. A significant portion of this is not what it appears to be. It is a paper construction built on a circular flow of capital between a small group of companies that are essentially recycling money between each other and booking the gains as real profit. Here is a simplified version of how it works. Imagine I lend you $100. You use that money to buy an asset. That asset appears to rise to $1,000 in value on paper. I am now allowed to record $900 in profit on my books, even though nothing was sold, even though that gain exists only as a number. I then use that paper profit to justify lending you $5,000 more to repeat the cycle. That is roughly what is happening between the largest technology companies in the world. Analysts at the Financial Times examined the capital expenditure plans of Microsoft, Google, Amazon, Meta, and Oracle through 2030 and compared them to the expected revenue those investments would generate over the same period. They applied the most generous assumptions possible, assuming zero operating costs, no salaries, no electricity, no overhead. Under those conditions, Google's implied return was negative 15.7%, Meta's was negative 28.8%, Oracle's was negative 35.6%. The only company that crossed into positive territory was Amazon at 7.2%. Those are the best case numbers. To fund this spending, those same companies have issued more than $150 billion in corporate bonds this year alone, more than double the pace of just 2 years ago. The free cash flow margins at Microsoft, Meta, and Google have collapsed towards zero when you account for artificial intelligence capital expenditure. JP Morgan analysts project that by 2027, several of these companies will have negative free cash flow, meaning they will be spending more than they earn. And look at who they are spending it with. OpenAI has committed $280 billion to Microsoft and $138 billion to Amazon. Anthropic has committed $30 billion to Microsoft and $100 billion to Amazon. The combined spending commitments of OpenAI and Anthropic represent roughly half of Microsoft's entire revenue backlog, 54% of Oracle's, and 51% of Amazon's. The money is moving in a circle. Large technology companies invest in artificial intelligence startups. Those startups use the money to rent computing power back from the same large technology companies. The technology companies book those investment gains as profit and use that profit to justify more spending. The loop keeps spinning as long as everyone agrees on the valuations. The moment these companies go public, that agreement ends. Valuations stop being whatever a small group of private investors decided in a closed funding round. They become whatever the open market decides they are worth. If those numbers come in lower than what Google and Amazon have been carrying on their books as profit, those profits have to be revised downward. The earnings that justified the stock prices get corrected. The loop runs in reverse. That is why the timing matters. That is why the rules were changed. They need these IPOs to validate the paper before the paper runs out. Has this happened before? Yes. The Financial Times has charted the most culturally significant and heavily anticipated IPOs in American history against the broader stock market. Xerox went public when investor excitement was at a peak. The market peaked shortly after. Ford, McDonald's, Apple, Goldman Sachs, Blackstone. In almost every case, the most anticipated IPO of its era marked the high point of public enthusiasm, and the market declined in the period that followed. The IPO is rarely about the company needing capital. It is almost always about early investors needing an exit. The best time to find buyers is when demand is highest, and demand is highest right now. By the time SpaceX, OpenAI, and Anthropic complete their listings, they will have raised an amount of capital comparable to all of the dot-com IPOs from the year 2000 combined, adjusted for inflation. Many observers have pointed out that this moment looks different from 2000 because the price-to-earnings ratios of artificial intelligence companies are not obviously extreme. In the dot-com era, companies were trading at hundreds of times their earnings with no path to profitability. That is not what we see today, and that is a fair point. But according to research from BCA, this may be more dangerous precisely because of that. The dot-com bubble was a valuation bubble. Prices went up while earnings stayed flat. This one may be what analysts call an earnings bubble. The prices look reasonable, the earnings look healthy, but the earnings themselves are what may be inflated. That is the distinction that matters. If the circular capital flows we described are propping up the earnings of Google and Amazon, then their price-to-earnings ratios look fine because the denominator, the earnings number, is being artificially supported. The ratio is not wrong, the earnings themselves may be. History has a clear record with earnings bubbles. Before 2008, home builders had perfectly healthy earnings numbers right up until they did not. Banks had clean balance sheets until the assets underlying those earnings were revealed to be worth a fraction of their stated value. In each case, earnings looked stable until the day they collapsed. The same pattern is emerging in semiconductors. Global semiconductor sales have gone nearly vertical. And in every prior instance in modern history when this happened, what followed was a severe earnings contraction. More precisely, the stock price peaked before the earnings turned, which means investors who waited for the earnings data to confirm the downturn were already months late. Nvidia peaked in December 2001 and declined 83% before earnings confirmed the move. It peaked again in November 2021 and declined 53%. Micron, Intel, and the broader technology sector have all followed similar patterns across every semiconductor cycle in modern history. The price discovers the problem before the reported earnings do. Something unusual is happening in the broader market right now that echoes this dynamic. The S&P 500 recently posted 4 consecutive record highs on what is called negative market breadth, meaning the index itself was rising while more individual stocks were falling than rising. The gains were concentrated in a small number of very large companies, while the broader market deteriorated beneath the surface. According to available historical data, this combination has not occurred before in market history. Artificial intelligence-related stocks now represent approximately 49% of the total market capitalization of the S&P 500. 41 companies out of 500 account for nearly half the entire index. If anything undermines confidence in those companies, it will not affect only technology investors. It will affect every retirement account that tracks these indexes. Now set all of that against the macroeconomic backdrop. The Strait of Hormuz has been closed for 3 months due to the Iran conflict. ExxonMobil's senior vice president warned at a New York conference that oil inventories could reach critically low levels within 2 to 3 weeks. His price estimate was $150 to $160 per barrel. If oil reaches that level, every country that imports oil needs significantly more dollars to pay for it. When countries need dollars urgently, they sell their dollar-denominated assets. The largest dollar-denominated assets most foreign governments hold are U.S. Treasury bonds. Selling treasuries pushes yields up. Higher yields raise borrowing costs for governments, corporations, and consumers across the board. Tracking data shows that since the beginning of the Iran conflict, Treasury yields have moved in close correlation with oil prices. If the Exxon estimate is accurate, yields could reach levels that begin to cause structural problems in credit markets. Early indicators of this are already visible. Emerging market countries sold U.S. Treasuries in March at the fastest pace since at least 2023. 27 countries have approached the World Bank requesting emergency financing. Long-term government bond yields are breaking out of multi-year consolidation patterns across the United States, United Kingdom, Germany, Japan, and Canada. The Federal Reserve's new chairman was appointed with an expectation of lowering interest rates, but the market is now pricing in rate increases. For the first time in 4 years, the 2-year Treasury yield is above the federal funds rate, which is the market's way of signaling that tightening, not easing, is what conditions warrant. If the Fed chairman lowers rates into an inflationary environment driven by rising oil, the dollar weakens, inflation accelerates, and bond yields rise further as investors lose confidence and sell more treasuries. If he raises rates, borrowing costs increase, the stock market contracts, and the entire artificial intelligence spending cycle which has been contributing to the majority of recent GDP growth, now faces a much higher cost of capital. Either path leads to rising yields, and rising yields are the single development most capable of unwinding everything described above: the paper profits, the circular spending, the 150 billion in corporate bonds, all of it. At the precise moment, the three largest IPOs in history are attempting to reach the market. That is the context in which these rules were changed. The window may be closing, and the people closest to this situation likely understand that. None of this means that investing is irrational, or that SpaceX is fraudulent, or that artificial intelligence does not work. It does work. Starlink is genuinely one of the more impressive technological achievements of the past decade. Artificial intelligence will reshape significant parts of the global economy over the coming century. That is not the question. The question is whether the technology winning and the investors winning are the same thing. History says they are not. In the late 1800s, the railroad boom transformed the American economy in ways that are still visible today. The technology was real. The infrastructure is still in use, and almost every investor who funded the original railroad boom was wiped out. The companies went bankrupt. Then a second generation of investors purchased those same assets out of bankruptcy at a fraction of the original cost and built fortunes. The same pattern played out in the fiber optic cable boom of the 1990s. Hundreds of billions of dollars were spent laying cable across the country and under the oceans. The companies that built it went bankrupt in the dot-com collapse. A decade later, that same infrastructure became the backbone of the internet. The technology won, the initial investors lost. The people who arrived after the wreckage built the world we are living in today. That pattern is the most likely template for what happens with artificial intelligence. The technology will continue to evolve. The early investors and the passive funds, forced in by rule changes at peak valuations, may absorb the losses. And a new group of investors will acquire these assets at lower prices and build the next era on top of them. So what do you do with this information? The first step is simply knowing what your index funds actually own. In the coming weeks, they will own SpaceX. After that, OpenAI and Anthropic, at entry prices that historical precedent suggests are unfavorable for passive investors. That does not necessarily mean selling everything, but it means you should understand what you own and why. The second step is thinking about where your capital should be positioned to remain resilient across multiple outcomes, because no one knows with certainty what happens next. Perhaps this is not a bubble, perhaps the IPOs succeed, perhaps the Federal Reserve manages the transition smoothly, perhaps the AI boom generates returns that justify the capital spent. Perhaps history does not rhyme this time. That is possible. The role of investing is not to be correct about a single outcome. It is to allocate capital across probabilities, because the future does not announce itself before it arrives. If this was valuable to you, share it with someone who needs to hear it. Financial education is one of the most important gifts you can pass on. Like and subscribe. I'll see you in the next one. Thanks for watching.